Welcome to EDS, and in this video I'm going to share with you why most traders fail and how you can be a winning trader. So why do most traders fail? It's simply because they don't win often enough. Anything above a 50% win rate is considered to be high. So if you're winning 50% of your trades, that means you have to manage 50% losers, right? And what I'm going to show you in this video is how to get very, very high probabilities of success. And this isn't just going to be me saying it. I'm going to show you with statistics how to get a high probability of success. And I'm talking about 70, 80, sometimes 90% probabilities of success. Okay, so the first thing that you want to do is pull up your brokerage platform and you want to go over to your watch list. Now we are going to be writing options contracts because that allows us to get high probabilities of success because we can choose which contracts we want to sell. Now writing contracts and selling contracts are basically the same thing, and you're going to see why that's super important as we get further into the video. So once you have your watch list open, it doesn't matter what's on your watch list, just make sure that everything on there is fairly liquid. You don't want to be trading things that aren't liquid because it's going to be difficult to get filled. You're going to get a high bid-ask spread, and the spread is what you pay every time you get in and out of a trade. So you only really want to be interested in liquid underlyings. Now you also want to have this metric here, IV rank. Now you want to order your watch list from high to low IV rank, and you don't want to trade anything with an IV rank of less than 30. So our cutoff point would be SMH here with an IV rank of 31. So anything above SMH right now would be absolutely fine. And the reason why this is important is because when volatility rises, option prices rise. And remember, we are going to be writing or selling these contracts, which means we are effectively short the contracts, which is the opposite of what you will see on social media nowadays most of the time. Now, whenever we are short something, it means we want to sell high and buy low. And because we know that option prices rise when volatility rises, we want to sell when volatility is high, when option prices are high, and then buy back lower after volatility has contracted. And volatility is mean reverting, and most of the time volatility is contracting in the market around 80% of the time. So with that in mind, you want to go down the list and see what would fit well in your portfolio. And what do I mean by that? So depending on the size of your portfolio, you're not going to be able to trade some things. So for example, we have UAL that's trading at just over $108. If you have a small portfolio, you're probably not going to be able to trade UAL effectively. I mean, you can do some defined risk strategies, but we want to focus on undefined risk strategies. And so what I'm going to focus on today is INTC, or Intel. It's trading at under $20, and an underlying like this will fit inside anybody's portfolio. I believe that the requirement to get a margin account with most brokers is $2,000. So by all means, when you do have a very small portfolio, you will have to sort of bend the rules a little bit in terms of your risk metrics. However, the smaller the underlying, the less buying power that's going to be required for equities, at least anyway. So I have had some people message me inside our private Discord asking to go over some smaller underlying stuff, so that's what I'm going to be showing you in this video. If you do have a larger account, then by all means feel free to trade whatever you like, whatever you choose. Just make sure it fits well in your portfolio. Don't be too heavy in any one sector or industry. Keep things nice and diverse. So without further ado, let's look at Intel. It's trading at under $20 a share. It's got an IV rank of 50, and it has an absolute IV level of 51.9%. So let's open up the trade tab, which is where we can see a list of expiration dates, specifically option expiration dates for Intel. And the expiration date that we want to pick needs to be a monthly, not a weekly or quarterly expiration date. And we also want it to be between 30 and 60 days out in time. And so there's one here at 44 days away, and that's the one we're going to go with. That's the only one that actually fits that criteria right now. So March 21st. So let's open that up. And now we are presented with the options chain. So we have calls on the left, puts on the right. We have our strikes going down the middle. This orange horizontal bar shows us where the price of the underlying currently is with respect to the strikes. We have these dotted blue lines which show us our standard deviation levels, which is going to be very important in order to get a high probability of success. And we also have the expected move here shown in the top right in parentheses next to our IV level. It's currently plus or minus 2.35, and that's also visually displayed with this vertical orange bar here in the middle. Now, when we are short an options contract, we want price to stay away from that contract. We want that contract to stay out of the money, and that's how we make money. Basically, that's how we're going to profit. So if we know what the expected move is, all we need to do is simply sell contracts that land outside of that expected move. Now the question is, how far out do we go? Because the further out you go, the higher your probability of success will be. However, the less premium you will also collect up front. So a balance, in my opinion, is to be around the 1 standard deviation level, and that will typically line up with a delta of between 15 and 20, and your contracts should then at that point be sitting outside the expected move, but not too far. So let's have a look at Intel. So we have an 18 delta here on the call side. We'll sell that contract at the 24 strike. And then we have a 17 delta on the put side at the 17 strike. So now what we've done is we've essentially created a range for ourselves. Okay, price is currently here between 19 and 20. We have our contracts at 17 and 24. Both of our contracts are up against the 1 standard deviation level, and they're both outside of the expected move. So we're going to get a good balance of probability of success and return on our capital. So what is the probability of this trade working in our favor? Well, if we look in the bottom left corner, we have a pop here, which is currently at 72%, and pop is probability of profit. So we have a 72% chance of making at least 1 penny on this trade in 44 days time. That's assuming that price is either within this range or along our break-even points. So what are our break-even points? So we would collect 66 cents per share on entry. So our break-even points would be $24 plus 66, $24 plus 0.66, and then on the put side it would be $17 minus 0.66. So our break-even points are slightly wider than where our contracts are, and we have a 72% chance of price being within our break-even points in 44 days time. Now, what if we don't want to wait till expiration? What if we want to get out at, say, 50% of max profit? Well, we have this P50 number here, which is currently at 85%, and that number tells us that we have an 85% chance of hitting a 50% profit level at some point over the next 44 days. So we are looking at probabilities of success of between 72 and 85%, and we've not even put the trade on yet. This is before taking into account that implied volatility is generally overstated compared to actual volatility, which will bump those probabilities of success up even higher. And then once you become a little bit more advanced, you can start to make adjustments. So for example, if your strikes get breached, you can roll your contracts up, down, out in time. There's so many ways that you can manage risk with an undefined risk trade setup like this. So in actual fact, our probabilities of success will be much higher than what is displayed here, but even still 72 to 85%, that is very, very high. Now, as we briefly mentioned, we would collect 66 cents of premium upfront per share, and each contract controls 100 shares of the underlying for equities. So this will be multiplied out by 100 to get our max profit of $66. So we would collect $66 upfront, and that would get added to our cash balance as soon as this trade gets filled, and that would automatically be done by our broker. Now our broker is also going to require $217.50 in buying power to open this trade. And this is what I was referring to about the smaller the underlying, the less buying power that will be required for equities. So as long as $217 will fit inside your risk parameters, which is what we're gonna go over that in a little bit more detail in just a second. But as long as you can afford to allocate $217 to an undefined risk position, you can place a trade like this. The underlying is under $20, doesn't require much buying power. You're getting a good return on your capital. Remember, that's just in 44 days time. And we've got between 72 and 84% or 85% chance of this trade working out in our favor. You also don't have to wait until you hit 50%. You can take your profit at 25%. I personally wouldn't wait longer than 50%, but anywhere between 20 and 50% is good. The less profit that you're happy to take, the higher your probability of success will be. So if you're happy to take 25% on a trade, then you're probably going to have a probability of success of over 90%. So with that in mind, how much buying power should you be allocating to your position? So in order to figure that out, because for everybody it's going to be different, and it does also depend on volatility in the market. So in order to figure that out, we've created a free position sizing template. Everybody can get it completely free. Link is in the description. Just click the button and it will take you over to this spreadsheet. And the way it works is you enter in the size of your portfolio. So say if you have a $15,000 account, you can enter that at the top, and then below it you enter in whatever the current VIX level is in the market. So say if it's 18.2, and then everything below will be automatically calculated for you. It will tell you the maximum amount of buying power to allocate to a single defined risk position, undefined risk position, how much short premium you should have in your portfolio in general, the minimum amount of your portfolio to allocate to undefined risk trades. What we went over today was an example of an undefined risk trade. Now, do keep in mind that if you have a very small account, then you may not always be able to stick to these guidelines. You may have to be slightly more aggressive. That's just the way it is. But try and stick to this as best as you can. And if you have a larger account, you definitely should not be violating these guidelines. And as long as you stick to this over the long run, you'll be absolutely fine. So if you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium and get yourself signed up, and inside you will have access to our portfolio that will allow you to see the positions that we place, how we manage risk, the adjustments that we make. Everything is posted in real time for you to see or copy if you choose to. There's also a full course, so no prior knowledge is required. We will go through everything in detail from start to finish. And there's also a private community. So if you ever get stuck at any point, you can speak directly with myself or with other like-minded individuals and share ideas. And there's also a 100% money back guarantee. So once you've been through the course, followed some of our trades, if after 6 months you are not profitable, then we will work with you for free until you are, or you can just request a full refund. So it's completely risk-free, and right now it's $9.99 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life. Whatever price you get in at, that's the only price that you will ever have to pay, no matter how high the price goes in the future. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to teach you the skill, and once you know the skill, it's something that you can take with you for the rest of your life. No one can ever take it away from you. And we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You are always, of course, welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.